and if anyone's interested, that's lindaanddamontrade.com. You can go there and take a look at that. But I see some of my friends in there, which I love. It's kind of like the floor, but instead it's online. In the old days on the floor. So I'm going to move in a second to the next slide, and we'll get started. All right, so let's see how many. Yeah, they're rolling in still, but let me start here. Most of you guys are here anyway, at least I think. I'm putting up this disclosure. As you know, you've seen, I'm sure, probably seen so many of these disclosures, but I definitely have to do this. It's regulatory. Any kind of trading, by the way, all of you know that trading futures can have inherent risks. We know that, right? But in case you don't, I'm telling you. And because of the volatility, especially lately, and the leverage, right? Never trade with your last dollar. It's my kind of thought process, because you're not going to trade comfortable. And anything that we're showing you is best effort. We're not guaranteeing anything, forward or not. It'll look back. We're trying to do our best. Both Linda and myself, we've been into business, me 42 years. Linda pretty close to that. She's a little younger than me. But anyway, I'm going to start out by letting Linda start the webinar. Let me just see how we're doing here in the room. And I think we should get started. So Linda, are you there?
I am here. I am here. Can you hear me?
I can hear you loud and clear.
Okay, now we're using GoToWebinar, not GoToMeeting.
We're using Zoom.
Right, but I meant we're using the meeting version versus the webinar. Anyway, I have to change.
No, we're using
reads.
Right, so I have
Jeez, it's Sunday night. Don't confuse me. Okay, seriously.
All right.
Okay.
All right, go and share the chart you want.
There we go. All right. It says I can't share the screen because the other participant's sharing. So knock it off.
So, okay, let me see.
You got to close down yours before I can open mine. That was my whole point. I promise you guys are watching the Linda and Damon show. Here we are. Like, we're not using our regular Zoom software that we do. I don't know why we're using this one, but anyway, we are. So we're going to get this ball rolling here. First of all, I wanted to start off, okay, what do you say on a Sunday evening?
Did you go ahead and share? I stopped sharing. Share your screen now.
There we go. Okay. Yeah.
There we go.
So like I always try to be creative and think about a good lead-in, and on Sundays, sort of more of a philosophical day for me, and hear all this stuff about our mental health with social distancing. And I'm driving to the barn today and I'm listening to this show on PBS, and it was like, seriously, it was about loneliness. And I'm like, no, I am not going there, and about the importance of relationships and community and so forth. And I'm like, I could take that ball a little bit and go with it. Isn't it great that we've got this online community and family and relationships, blah, blah, blah. Okay, so I'm like, no, I think everybody's had their dose, their dose of that kind of stuff. And I'd rather just stick with the hardcore technicals because that's what I'm best at. I'm not a counselor or anything like that. And so I wanted to preface this because there is all this overwhelming news and updates daily, and is this taken open or not, and all this kind of stuff. And so I wanted to preface this by one of the premises of technical analysis that is so important, and that is that the markets are discounting mechanisms, and that means that they discount looking out 6 to 9 months. And let me just elaborate on that a little bit further. Okay, so that's assuming that the market is instantly trying to discount all available information that comes in. And that's why when you do have a shock event like this initial realization that this could transmit and more quickly than ever and become a pandemic, there's a great deal of uncertainty. There's tremendous uncertainty about how, you know, the death rates and the economy and all this kind of stuff. But at this point, you know, it's pretty well priced in. I have to go under that assumption that okay, the economy is going to get whacked. We know that, you know, it doesn't do any good to read about it or hear about it, you know, and maybe the death rate's not as high as it was going to be. You know, all these things really shouldn't matter, you know, because I have to operate under the guise that the market knows better than I do. And with that said, it doesn't price things perfectly. Okay. In fact, I think it was in 1966, Paul Samuelson, a very famous economist, said that the Wall Street industries predicted 9 out of the last 5 recessions. So there you go. You know, sometimes it's a little bit over dramatic and so forth. You know, but looking at news at this point is not going to help your trading. And if anything, it can start to be this psychological weight on you that's compounded by those of you that have been subjected to more, you know, staying indoors than others, you know, particularly if you're in a major city. I feel kind of blessed because I'm in Florida and I can walk outside and it's no big deal. But, you know, it's been a long period of time. And so don't let that start to affect your psyche and your mental balance. And the best protection against that is to try and stay with statistics, stay with technicals, ignore, you know, all this heaviness, and people might get excited that, you know, economies are reopening or states are reopening and all this. None of that means anything if you operate under the guise that these markets are discounting mechanisms looking 6 to 9 months out. And of course, that picture can change, you know, 3 to 4 months down if there's a new event risk or whatever. So I'm going to show you my work today. And I try to go by the sentiment readings, the monetary readings, and the technical readings in terms of momentum and structure. So those are the 3 primary ingredients that sort of make up my macro modeling, if you will. And then as a sidekick, you know, we'll look at some seasonals. And what I want to show you is that right now, the market's reached a relative equilibrium point. So, you know, it's not that we want to say, oh, it's going to be a big bull market going forward, or the bear is going to kick in and slam us to the downside. No, everything right now is showing that the market has arrived at a relative equilibrium point, which is a good thing because it can offer two-way trading opportunity. It's not the same momentum plays we had in some of the stocks and so forth. And that's going to be really important to look at this week because we have Google reporting on the 28th, Microsoft reporting on the 29th, Apple reporting on the 30th. You have basically 20% of a major index is comprised by 5 stocks. This actually is not so unique. We had this 20 years ago where 18.9% of the NASDAQ was comprised with just 5 stocks. So the fact that there's so much attention, you know, focused on these really is not new in terms of a structural phenomena where the tail is wagging the dog. But still, that makes this an incredibly important week just for the earnings. So I'm going to start off by showing just my brief overview of the sentiment readings, the monetary conditions, the seasonals, and a little bit about the big picture structure, okay? I'll turn the ball over to Damon. And then when we come back at the end of this, I want to look at individual stocks. And I had some requests from a few of you to look at one or two additional ones. So we'll look at that. So let's start off just by looking at something very interesting. Okay, what was interesting is my main components for looking at sentiment readings are the AAII readings, American Association of Investors, the Investors Intelligence, put call ratios, just those are sort of my main ones. And it was really interesting that there was such a skew in these, and I'll show you why. So if you look right here, if you can see my screen right here, and I do know there is a drawing tool, but I can't find where it is on
Yeah.
my magic little thing. But I'm pretty good without. Okay, I found it here. So I don't know if you want to see me draw on a. Yes, I don't know. Goodness gracious. Okay. Here we go. All right. Oh dear, my mouse must have had not a good sleep last night. I'm not going to use this. This is terrible. All right. Take
Well,
two.
you want to use the Zoom tools?
That's what I was trying to do. Yes. So I'll let it be. Let it be.
All right.
You can see in this middle box here, though, that we had a pretty good swing from the bulls and the bears. So just 2 weeks ago, it was quite remarkable that the bears were a greater percent than the bulls. And now you can see it has swung all the way back into the other side, where the bulls are 43% and the bears are 30.8%. Now, traditionally, looking back, a top in a market generally is not reached until you start to see this bullish reading above 50. And before we had this downside implosion, if you look over here, the sentiment was starting to improve from this very bearish previous year, and it just never quite got up to 50 or 60, rather 60 I meant, before we had this event happen. So we never quite reached that frothiness that we would have expected, but now we're way down here. And if I were just looking at this without the knowledge of the previous events, I would say that we have to eventually see this bullish sentiment work its way back up to 50, and that can take a lot of weeks. So there's still excess bearish sentiment out there, but not nearly as much as there was, because you can see the big flip the previous 2 weeks. Okay, get out of here. And then I wanted to go, well, we can actually just use this. This, by the way, is a free resource. Ed Yardeni is a longtime technician, 45 years plus, and you can find his work online. So sometimes I go and I look at that. When we were at that extreme low, okay, you can see how rare it is that we actually had that bearish sentiment reaching above that bullish sentiment by that extreme. It's really rare that we hit that type of sentiment extreme. And indeed, you can see they look at the ratio here, and we only had a previous instance, which was at that low at the end of 2018. And before that, it wasn't until 2016. So you can see these remarkable inflection points really don't occur that often. I'm going to get down here to here we go, to the AAII reading. And this is kind of unique because it shows that actually the bears increased and the bulls decreased this last week. So these things are just a couple days delayed, but this is sort of an anomaly where you've had one sentiment thing trend in one direction and another in the opposite direction. And part of that you have to understand is the way these polls are conducted, you know, is how stable is the base that they're polling, and is it sampling a different group every time, and so forth. So I'm not going to get into that tonight, but that can cause some variance. So when we look at different sentiment readings, what we really want to see are when you start to see a real confluence of these things. And here's just a different way of looking at that AAII reading on stock charts. Okay, so AAII, it just shows a little bit more of the history than the previous one, and you can see that on this one there's still quite a lot of bearish sentiment. So far we've seen that with the investors intelligence, it's improved a lot in 2 weeks. It's not near any frothy levels, and this one here is just, wow, you know, it's like a doom and gloom here. So there is still plenty of potential for this sentiment to be a supportive factor. Okay, that's the main thing. If you have too many bears, that means that there's still cash on the sidelines and there's still money that can come in and be invested. This is the put call ratio, and I only look at the equity put call ratio, and you can see this gave an extreme buying signal, and now it's really worked back down to neutral. So I consider 60 to be a relatively neutral reading. If you ever see it drop down to 50, that's a good sell signal. So we did get a sell signal in the put call ratios up at the top, and part of that was caused by this move of these houses to go to commission-free trading. What the heck are they thinking? I have no idea. But that was also coupled with the earnings reports that we saw, the first earnings, you know, in first quarter this year, and that caused quite a lot of speculative excess. So this was the one sentiment reading that gave sell signals up there at the top. And you know, these charts, a picture's worth 1,000 words. But just suffice to say, this is pretty neutral right now. So to sum that up, you've got mixed with sentiment. All right, there's plenty more room to go to the upside. It's not reached any extreme where I would be saying there's sell signals. And that's the main thing we have to keep in mind, that it's like so far so good, so far so good, you know. And then let's just go down though and start looking at these seasonals, because we looked at this last week, and so I feel compelled to update this. This is a real rough guide. It's nothing significant about the entry or the exit date, but we have had long seasonals all through the month of April. It's one of the most bullish months of the year, April is. So we still have the Dow on this long seasonal all the way through till the 29th. All right, so there's still some lift from that. There's nothing negative hitting the fan, and that's the primary thing that we want to look at. If we were just to see, just do a little sneak preview on the May calendar here, we can get a slightly different picture that May can have a little bit, starting with the second week. Okay, you see here Friday the 8th, you can get a little bit of a downdraft, all right, in this Dow here, and then at the very end of the month, the S&Ps kind of kick in that last week. So let's put that in context. So far, we have sentiment readings that are really mixed. Okay, there's still, you know, no excess frothiness, but they've used up a lot of bullets to the upside. There's nothing screaming to the sell side, and the seasonal window still can be supportive for another week. You know, there's nothing major that's going to hit us with a downturn. And then lastly, the biggest consideration is the monetary environment. Okay, the U.S. putting an additional $2 trillion out there, and we're just one of many countries. So I do think that the market has been taking to heart these excessive liberal monetary components, and you don't see any immediate effect of that, because there's something with the velocity of money that if you put a dollar out there, it has to get passed on and circulated back and forth. And right now, I would suggest that reading is pretty much near zero, you know. So what happens is that a lot of these dollars that get put into the economy, be it in the form of loans or direct payments or so forth. And yes, we have to make up for that black hole that sucked, you know, a lot of dollars into a big black hole. But there's some excess dollars that get built up into the pipeline. And so I think that the market could be pricing in that these will eventually kick in one way or another, and some industries will benefit more than others. So going on to our thesis of the seasonals, I also look at the Commitment of Traders report, and just thought I would mention a few of the markets on my radar from both the Commitment of Traders and the seasonals. And then we're going to go down and we're going to look at the actual charts and the structure. And the first is the euro currency, because this actually, you can see here, going into, this is May, okay, so I'm giving you a sneak preview a week ahead, but this, from the start of May, it's a pretty negative month for the euro currency. And the site that, you know, what's so cool is that TradeStation now has all these Commitment of Traders reports on so you can plot them on the weekly graphs, and it looks really nice. And they didn't used to have that, so you don't even need to go to other sites. But I always go to this one site, COT Charts, just because I have for years. It's free. And I'm just going to show you, because this is the work that I do every weekend, just to see if there's anything that catches my attention. And this is the euro currency here. So it looked like the commercials were a little bit shorter than they have been in a while. So I'm going to make note of that, and I'm going to file that with this bearish seasonal coming up for the month of May. So that's a little bit more of a macro trade idea. And then on the long side, we actually have the December corn contract, gold, and no, not gold, excuse me, and natural gas were the two that had some bias to the long side. You can see the corn through the month of May here, and this market's really been in death's row. It's been one of the weakest ones on the board, so we definitely want to wait until it catches a bit of a bid. But that was really positive from the Commitments of Traders and the seasonals, and that should be starting in just a couple days. And then lastly, Steve Moore also publishes a free seasonal, and let me just see if it shows up here. This was the Australian dollar. So it has a little bit of a bias here at the just in this next week here. And whether it plays out or not, we always use price as our main indicator. So we're going to go down and look at these charts right now. And I'll just leave off right there with this Aussie dollar, okay? These are very small seasonal windows. I always like to look at the weekly charts in conjunction with these dailies, and this is just suggesting that over this coming week, we still have more upside in this Aussie. We've got a nice buy, first cross buy type of thing, and you know, pretty easy just to see if it can poke up above that previous swing low or not. It's up 23 ticks tonight, and structure looks fine, nothing to write home about, but you're working off this deeply oversold weekly condition like we saw on a lot of things. And then let's just go down, and I'll look at corn, although I'm not trading it, but this you can see death row, 1, 2, 3 pushes down, and this third push down was really dramatic. So, and this, I don't like to get caught in markets with such an ugly weekly, and I have, and every time it's a learning experience. So you really need to wait for a higher low in this corn. But let me show you what that can look like in a market that we just saw make a higher low, and it wasn't a perfect higher low, but it was a double bottom of sorts. And you can see on the 120 minute, at least you had a divergence on this time frame. So at least go and look for a divergence on the 120 or the 240 minute time frame. And I just thought this would be an interesting market to see what happens as well. We had a long trade in this market, but exited it, before it hit that moving average. Yeah, we're always a little bit out too late, but you'll start to hear in the news now a lot of the media hype about shutting down these processing plants. They're taking 25% of the capacity online, blah, 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 blah. And, of course, all the commercials know that, and they've been pricing this in. It's not looking like a huge dramatic bounce, but, just keep in mind, this is not new news. These plants were shutting down a couple days ago. And so at least if you can picture that corn in its free fall, you need to see a higher low or or some type of divergence before you stick your nose into those types of things. But let's get on. I don't want to do the stock work until after Damon has had his chance to say his stint, because I like seeing his market profile charts. And then at the very end, I'll also look at those market profile charts on stocks, because you might be surprised at the different picture that it gives. So remember, I said that we were pretty much at a neutral equilibrium level here. And what you'll see is that at this point, we have worked off that deep weekly oversold condition here. If I were to put simply a little 310 oscillator on there, good enough. And this is as an aside, sometimes when you're looking at stock charts that have gaps, or pit session data where there's larger gaps, or if there's an extreme unusual event, it's sometimes helpful to look at a stochastic instead of a moving average oscillator, just because this will give such a distortion. So either way, you see it's back up at a relatively neutral level, and I would expect that this is going to start to continue to balance, even though we do have a little bit of case we can make for perhaps a bit more upside. We may test this high up here with this earnings week and so forth, maybe just enough to get the sentiment one last EHA, okay? But I think that a good part of this rally is over for now, and we can still get another week of upside, but be careful here. And another reason why is because we also had this crude. Okay, when I was looking at the crude market commitment of traders and so forth, the commercials are very short the euro currency, but they are also very short the crude oil. So that tells me crude is unlikely to be going anywhere fast, even though it's kind of sexy and glamorous in here, the way it can swing and move. And there's nothing to say that we can't have, $2 to $3 up, $2 to $3 down. But there's like a little bit of an overhang on this crude. And so, we just have to pull in our horns a little bit there. So this is the S&Ps. Obviously, all eyes are going to be focused on the NASDAQ here because of these earnings coming out in Microsoft, Google, and Apple. But pretty good overhead resistance here. So the real question for me is going to be, will we retest this high? Will we just give a look above it? Or will we make a lower high? And when I look at these things, I also look at the position of this slow line. right? So the slow line is the fast line on the weeklies, but the slow line's pretty much given it everything it's got, okay? It's had a heck of a rally. The slow line now, it doesn't mean that this is going to fall right back down, because the slow line can correct back down just like you see it here. It can correct back down without the market falling out of bed. You know, there's been lots of cases. I know the data here is sporadic, but the slow line's not saying that it's going to fall right back down, but it's saying that it's basically given its best to the upside, and so we can start to rotate in there. I only have 2 or 3 other markets I want to show on this big picture daily weekly before I turn the ball over to Damon. Then he's going to go through all his levels for the upcoming week that show differently with these volume nodes. And then lastly, I'm going to show you some cool things with some stock charts, as well as maybe some trades that can set up for Monday. All right, so lastly, let's just take a look at these bonds, which have been a little bit of a conundrum. And I can't look at this weekly continuation chart because the spike is going to distort all the oscillators, but you can see that we are definitely contracting in volatility. So eventually, okay, same thing here. You had a little bit of non-confirmation with the 10 years poking above, you see, and the bonds failing to really poke above. So a little bit of non-confirmation, but we're really contracting in volatility. And if I were to throw up an ADX up there, it would be super low. And so I'm not really good at forecasting the markets when it reaches that point. I pretty much stay out of them. And that's another lesson too. There's a time to be in the markets and a time to stay out. And I think I just made one trade in these bonds in this last week, which is really my favorite market. So don't feel compelled to trade the crude or the S&Ps if you don't have a handle on them, or you can't make, you know, a good directional play, because it's just, you know, it's going to be a 50-50 type of bet. And so they've been much more difficult to read. So don't really have anything more to say on the bonds. We looked at this crude oil last weekend, if you remember, and we talked about how eventually there's a case to be made that this can go and get up to these levels up here, which I'm sure that all market participants are well aware of. But on the other hand, look at your weekly oscillator starting to correct back down, and these dailies can be a chop show for a little bit while to come. And the seasonals on this market don't really kick in until the end of July or the middle of July. So on one hand, this is a fairly bullish formation, thinking that you see an ABC down on this 120-minute here, right? Okay, if I just try to go to intraday data, and a little bit of a lift, but we're right in the middle of this chop show, and so I don't think that we're going to be taking out this high up here anytime soon. I think it's just going to be good trading range. I don't see any bearish sentiment in the gold. That's the biggest worry to me, especially since I can make all kinds of cases for it going higher, and you saw how it can have these vicious shakeouts to the downside. On another note, if we look at the silver market, and you were to go down and look at the commitment of traders reports on the silver, one thing you would notice is that there is a significant decrease in the shorts there. And in fact, I'll just put that chart up for you. So that is something unique. I haven't seen that for a while. Here is the chart of silver. And you can see that for sure, you know, the commercials have been much less positioned in the past, but at least they have been working off this excessive short bias that they had basically for the last 2-3 months. So that kind of caught my eye. I don't put a whole lot of credence into these commitment of traders reports as the basis for a trade. Same thing with the seasonal. It's not a basis for the trade, but I make it a point to look at them every weekend, and I just kind of file it away in my head. And then if there does seem to be a surge in volume in the direction of the seasonal or the commitment of traders, I might be more likely to jump in with a slightly bigger position or more leverage. So this is constructive, and it's same thing. There's nothing to say that this just can't do an annoying trading range for a while. So I'm sort of in the 1 day at a time mode there. So those are the main markets I just wanted to touch on. The S&Ps, yeah, there's a little bit more room for the upside, but you can see it's basically given the max from the weekly perspective. You've basically given it 95% from the sentiment side now. I mean, excuse me, from the seasonal side, right? And the sentiment stuff, you know, there's a little bit more room for frothiness, but it's not really screaming either way. And so I think that you're just going to see your volatility coming from the release of the Google, the Microsoft, and the Apple news earnings these week. And it could be a fairly quiet Monday going into that. So I'm going to turn this ball over to Damon because his charts are so much more compelling when it shows these major levels and the structure. So I'm going to stop sharing my screen here, and
All right, hang on a second here.
I don't know if I stopped sharing them.
We'll find out.
There we go. Stop share. Ha ha.
There
Okay.
you go. Okay. Okay, let's see if I can get this right. Oh, there we go. You can see it okay, right? Okay. You can hear me and see my screen, correct? Hello, Linda?
Yep.
Yep, good. All right, I'm not sure quite where to start, but let's take a look here. This is the S&Ps, the ES. And first, before I show you everything condensed, I purposely did this because I'm sure, you know, some of you might not use Market Profile or don't know much about it. So I wanted to be a little clear, like what some of these things are real quick so that you get something out of my talk, you know, if you don't know. But it's interesting to see it anyway. What I did is I took the Market Profile for one, and I broke just the day sessions out into the 30-minute bar chart. So you could see what this profile here is on a 30-minute bar chart. Same here. And I'll explain why it's important to be able to see this. But this is basically a 30-minute bar chart that gets condensed into a bell curve kind of distribution, right? These distribution charts really help me because it's more of a macro look. Now I use 5-minute and 30-minute bar charts and candle volumes, and I'll show you a couple of those too. But today I'll concentrate on what you see pretty much on Twitter. Some of you follow me on Twitter, or when you see these market profiles. I'll come back to this chart in a minute. And let me just see here. That's okay. Here we are. Okay, this is what we're doing today. What you're looking at is pretty much all 3 sessions. I break out the sessions. I break it out into a US session, the Asia session, and the Europe session. For me, that tells me a lot. When in the morning when I come in, I do a good portion of my homework in the morning because I want to see what happened overnight on these particular market profile charts, because it tells me a lot where the bottoms were. For instance, on Asia here, when Asia came out of this little box that we had, Europe didn't even take out this low, and this wasn't a great low. spiked single prints, which would be like a spike on a daily chart. We had double distribution. That's where the market opens up here, tries to balance a little bit, couldn't take it lower, and then the bigger, longer term time frame traders come in and push it up higher. And that could be some hedge funds, some bigger traders. And then you see we balanced here. Well, this balance here is important for me when the market opens up to see if we're going to continue the balance in this area. Let me get some drawing tools here. If I can find where they're at, that would be nice. Here we go. Okay. So for the most part, you'll see me do things like this, right? I look at the areas where I feel there's a lot of price overlap, more or less a value area, an area where, you know, the market, if it comes out of this here, let's see if we get continuation. And what happened on this day when we came out of it, and I had drawn in this little balance here, we came back down and we closed all the way down here on the downside. So it failed to could come out of this and stay there. So that was a failure, and that gave me a clue that we might try the downside. And we did. Once Asia closed and then Europe took over, you can see what happened here. So these things kind of give me a little bit of a clue. These reference points that you see that I put in, they're either major areas where there are big reversals or tops. They are high volume areas. You've heard of high volume nodes, low volume nodes. They both, those kind of nodes attract and detract the market like support and resistance, but they kind of, you know, act as support and resistance. And the formations that you see here could tell me a lot too. If you have a bell curve forming, like this is a perfect one over here. This would be like a textbook one. You got a couple single prints up here, a couple single prints here, right? Point of control is where most of it traded, is right in the middle. So what that's telling me is that in that particular session, the shorter term traders have control of it. And then you get this kind of push up and a push down, back and forth. Market goes up like a slippery slope, comes back down to the point of control, then it tries this side, comes back up. So every time it gets to these levels, it's down below, it's attracting buyers, and sellers, you know, start to thin out, and then the market turns. And that's where that whole auction theory is, you know, that this was originally designed by Peter Stottlemyre, which, you know, he came up with this back when there was no volume to be able to see some kind of data distribution, so that he can at least kind of, you know, look at price overlap, see where the tough spots are. And I'll show you a couple of things in a bit. But these distribution charts go back in the early 1900s. They weren't created just by Peter Stottlemyre. Okay. All right. So let's get back to this anyway. You can see we had a failed reject, you know, right here. You know, we're back down in this is the Asia session. We came out of here. But when we came out of there, we did not continue to stay there. We didn't have good volume probably. And so what happens is the market comes back down to a kind of a balanced area to balance. And usually if there isn't too much time spent in an area, like here, right? Let me get my little tools. They kind of call it a cave fill when you see like not too much, a very thin structure. And then what happens is we fill it in here, and together they become a bigger, you know, formation. And maybe then we come back out of it again to retry this high. I like retests of these highs. Failed retests of these highs are terrific, you know, for me anyway. You know, like when we retested here, you know, we came back down and then we came back up and closed, but that was just a retest of this high. These real failed retests of these spike highs, they're pretty, pretty important, because if they reversed up there for really hard, there's a good reason for it. If you've ever been to an auction, and you see, the same product being auctioned twice, many times you see the same product have 4 auctions. Okay, first we're going to do, let's just say for a second that you're doing 4 TV screens, flat screens, and they're $1,500 in the store. So they auction off the first one. Everybody gets really excited. You get buyers really to move it up, and right around 1,000, they start to drop off. 1,100, 1,200, and then maybe you get somebody who pays 1,300, only 200 below retail. That's pretty high, right? So now you just created a good top, because the next auction comes, the same buyers are going to look at that and go, hell, I'm not paying 1,200. I think the value area really is better around 800, and all of a sudden the value area is lower, and the retest, if they're, unless there's some new buyers that are interested in that product and feel that the price is worth it up there, you're going to fail at that high. That's the way I kind of look at it. In the pit back in the old days, the traders, this is what they did in the pit. They watched price behavior around highs, lows, especially Globex highs and lows, previous, swing highs. And they watch to see how the volume is when we're trading that. If you're making a new high and these guys are all buying, and you see, Goldman and Merrill back in the day, you feel confident going with it. If you see a quick test, couple buy stops up there, some retail buy stops, no big boys, really adding value to that price, saying that that's not a fair price, the market comes off. They would be selling into that. Well, that's the same thought process that we should be thinking about. And that's, what I do. I like looking at these volume candles. I like looking at the formations. This kind of formation here that you see here, right, happens to be double distribution. And the way that formation, what that's telling me is that when it came out of here, you see these little single prints in between. Buyers felt this is really the fair price. And so they created a new value area. And then what happened was we balanced around it, and then we took off. So Linda was right. Let's talk about the markets a little bit here. When I look at a basic bar chart, I also keep, these things in mind of, when I look at my market profile, then I look at a daily bar chart to kind of compare the two. They work really well together. The thought process here is that we move from balanced, an area with a lot of price overlap, consolidation, both buyers and sellers are trading fairly around the same price, or right in the middle somewhere where most of the trading is going on. It's thin. You can sell rallies, buy dips, because there's no big traders, no big hedge funds or institutional funds coming in to push it to a new area. That would be like a consolidation, price overlap, and value area also as well, where 70% of the trading took place. When we come out of that, you want to look at the value area, and how do we come out of this value area? For instance, this is, let me give you a better drawing tool on this. So this is the value area. That's where 70% or 67% of the time, or 67% of the trading takes place. It depends on who you talk to, the different values. But the basic idea is if it comes out of here, you want to see how aggressive it is. Do we get excess like this? Do we do this? Do we balance higher? We go up and we stay up there? If we do, and we start having some good volume up there and we create a new balance area, there's a it's not really necessarily golden, but it is a sign that we probably won't return back down to the original area, you know, that will end up there. So that's, you know, how I look at these things. Let me, one thing here, trying to get organized. We just, like I said, this is a free form because we're trying to show you current charts and something different and that kind of stuff. So let me see. So here's like a basic daily chart that I would look at. We had a really, I mean, this was a hell of a sell-off. We all know about it. The only real pit stop that we had was right here. You had this little like bear flag, but we continued down. But this was the decision point for me, this price overlap. When we came out of it, we went up, but we did more price overlap for about a week, week and a half in a big range. And then we came out of it and then we balanced again. And now this is really starting to get tight for me, kind of in here. Like Linda said, we could go a little higher. We could go break out of this. But I certainly am not going to predict which way it's going to come out. I might look at volume to see how it comes out of it. But this is, you know, kind of how I frame things out myself. Okay, so let's go back to a couple more charts, market profile charts. Well, here, let me do this. Like I said, this is fluent. I don't even know what charts I have up here. Here we go. Okay, you can see this chart. So this is like a short, you know, I'm a short, much more of a shorter term trader. Years ago, I used to take positions more. You know, I like to go for the singles, doubles, and then every once in a while you hit the sweet spot and you get a home run or you hit it out of the park. You know, some of the traders in the trading room know, you know, we could get 5 to 10 handles and then we could get a 30 handle run, you know. But, you know, I don't predict it. I let the market, you know, go and see if we got the wind behind our back and, you know, let the market take me out. So these are volume candles. I like looking at volume. And of course, at night, everything gets skewed, you know, but let me blow it up. And currently we're doing this little, you know, after we had this big pump up that we had and then boom, boom, boom down to here, the market is balancing. That's what you saw on my market profile. So it's easy for me to see on market profile, but if I did this, that's the balanced area right there. That's pretty much, in fact, this is the inside of this is kind of where the value area is. Now, if we come out of this with good volume like this, we might be on our way to retest that high. But that's a pretty good spike high. Plenty of excess there. We didn't spend any time, and when you don't spend any time there, that means it's almost like putting your finger in a fire. As soon as if that fire is real hot and you put your finger in, you're not going to keep it there. You're going to pull it out, right? It's kind of how these spikes are, you know. Now, I'll come back to this. I wanted to show you how I look at some of these things. I put some slides together on the fly here for you of current, you know, markets. And here, let me go back to here. Bear with me. All right, well, let's hear. I just made these charts tonight just to give you an idea. I look at these reversals, I called them pockets years ago, and Linda picked up on it. And it basically, the idea is when we make these reversals, there's a good reason why it reversed. So when the market went up, and I didn't like draw them up here, I just drew these bottoms. When we came back down here, this almost fits right in there like a pocket, right? You know, so I'm really careful of when we test something like this, is there volume when we retest it? I would much rather be looking to let it fail on a retest and buy it than to try to predict that we're going to go through it. If I wanted to wait for this to get penetrated, I would really want to see some good volume. This fit right into there. This pretty much fit into here. But look over here to the right. what happened? When volume picked up, and then it just kept getting bigger and bigger as it went through, and then the market really sold off. And on the pullback, it went right back into the pocket. This is recent, this was the gold. And then here's, the retest in the gold. So, it's just the way I look at it. And then here's just, this was a play that we did, one of the trades. This is not really a great bottom. We had a lot of price overlap. They spent a lot of time there, but then usually the market will take a break and then they come back and I'm not saying that you get short down here, but when you come back down there, if you get a sell, there's a good chance they'll retest this. And we did. We went down there and we retested it. So, as the market sold off, you can expect the retest. When we came out of here, this retest failed. That was a good buy signal because we held this, and then we started up. So these are, I look at the way the volume acts, and this big spike is like excess single prints, and then we got a nice move out of it. Okay. Here's recently, like 2 days ago, when we came out of this, we like I said, we came out of here, came back into the value area, kind of the consolidated area, and then we broke down. And like I said, if I look at Europe, in the morning when I looked at Europe, I went, wow, they tested it, failed, balanced above it, and then you got double distribution up here. And then that's where we're at right now. So, then we went in, we put in that other over here, this chart here. And this is what we're doing at the moment. So let me see, I've got a couple other charts and I'm gonna just turn it back over to Linda. Okay, I didn't mean to do that, hang on. Here's the gold. And actually I'll go back right before I turn it over to Linda and we'll look at a couple levels too in this boost. But this area, there's a couple areas here that I liked that I felt were real good. So I put in these reference lines and I look at these when we come up to them as resistance. And if they get through it, then I look for us to go on to the next point. That's kind of how I look at these major resistance levels, kind of as pivotal. Some of them are very pivotal. So like when I put on on Twitter, if I say this is my pivot, that just means that above it, I like them, below it, I don't, kind of thing. Not to say that you just quickly get in and out of any level. You shouldn't do that. Wait to see how the price behaves when they go through a level to determine if it's through it. And these high volume nodes, sometimes I look at the high volume nodes, I said, actually this level going all the way back, it was the point of control. This is where we failed back. These charts go quite a bit back. And I take these levels from as far back as a month. I don't go too far beyond that. And then I look at the way the structure is on some of these. Here we kind of did this little price overlap. When we came out of here, that's when we moved the market to a new balance area. That's, that happens to be the gold. Now the crude's a whole other market. That's pretty wild. Let's see if I think I got the crude. So this little area here, the June crude, when it broke, it didn't even hardly trade there. I looked at the actual time in sales and there was nothing going on here. It broke so hard, if you remember, because the Mays were going negative, but it started in the Asian market. And then that's when, it really continued here after May went negative and took the June's all the way down to $7, But, that's also more of a fundamental thing too. We knew that there was issues with storage and all these other things, but it's important to still have these levels in, like this high volume node or, previous days highs and lows. And in this case here in the crude, we're doing this little balancing act at the moment. Like Linda said, I don't think we're going to go anywhere fast, either way, because the market has never been in this type of environment where we don't know. I mean, you got, the Corona thing, and no one's using gas. They have no storage for it. So it's an unknown. And, if the market, if the economy picks up and we start to see some consumption and maybe they feel it's a good thing, and then you see us, we rally up. They're also talking about, some of them are talking about that we can have the same issue with May. So wait for confirmation. I'm looking for this inside level here between 1830 basically and 1550. Above or below that, maybe we get some kind of like push, but I could see that the market really contracted, and I'm sure it's going to be a little bit quieter until there's some kind of confirmation of where we go from here with as far as consumption and all that. And then I'm just going to show you one more chart, and then we're done. I didn't want to take up all the time here. So in the SPOOs, this level here that we had yesterday's high, Friday's high, it's going to be kind of pivotal. You can see we did this little pin above it, poked it, and we came back below it. But it's around 37, 36 to 37 will be pivotal. We get back above here, whether it's tonight or tomorrow, and we try to eat some of this tail out. We could go higher. But like I showed you on the daily, to me, it's almost like a little bit of a, if you look at it this way, kind of like this, a little bit of a kind of a triangle. And it's not going to come in that well because I have these expanded, but that's what I'm looking at the moment. I think if the market does take out this area down here, we had quite a bit of a bounce, then we could see some, maybe a little retracement to the downside, because we did come off those lows extremely strong. In fact, we had the biggest up month, which is so strange and obvious. It's because we had such a major sell-off and we were oversold, but we had, I think, the biggest up month in history, from what I understand, going back. So coming back down wouldn't be a surprise to me. All right. Well, I will let Linda take. Linda, you want to take over? And
yeah, let's just wrap this up with looking at some stock charts and some plays for this week coming up. Let me see here.
Okay, I'm going to stop sharing. Okay.
There you go.
There you go. You should be good to go.
All right, let's just look at some, there's 5 stocks I want to look at here. Google is the first to report. That comes out on Tuesday, and you can see this big fat coil here. There's nothing to suggest that this can't take out the upside. I don't know how far it will get, but you've got this tail area here, so that's number 1. And then with all of these that have this 2-week bars of overlap, and there's quite a few of them. Okay, this is where you can ultimately set up your bull traps, and the reason I say that is because the weekly charts have already pushed up a significant amount. You had your base down here, a leg up. This is, I think, rather bullish looking, and I just don't know how much more there is to the upside. So we just need to see that last little bit of speculative froth or blow off. And what I would be looking for with a stock like this would be for a test above this previous high. And it could go, who knows, as far as this. I'm not going to earnings are a little bit of a wild card, but that would be the main play that I would be looking for, is one more push up. You can see this daily oscillator here is poised that if it wants to go up, it can, and this high is not very far away. So I'll be watching that to see if it wants to do a little bit of a squeeze to the upside and then come back down. As an example, we can also go and look at Netflix, which had its earnings, and you can see that when the earnings came out, it really sort of did nothing. So it may be that a lot of this is already priced into these shares. I wouldn't say that this is bearish or bullish. It looks like a flag, but it's so well up off of its lows, it can be one of those things where it just retests that high and that's it. Now, if we go down and look at Microsoft, we see the exact same type of configuration. The only thing that's more interesting with Microsoft in my book is that this is truly not that far away from all-time highs. And that can also be a little bit of a trap. Everybody starts thinking, oh, it's going to be making all-time new highs. Well, a lot of stocks did make all-time new highs, but I would just suggest that if it hasn't done it by now, when those other ones were making it, it's a lot less likely to. For starters, eventually, yes, but not right now. But at least we can see if it's going to go up towards this 180 level. So that doesn't happen until Wednesday. And I just want to point out to you this really nice 5 SMA trade that it had, and you can see that we had multiple closes on one side above the 5 SMA, your close below this big flush down here, and then it's met its objective, which is the retest back up above that 5 SMA. So the buy for that particular model has already played out. And let me just show you one other thing, what this would look like on this market profile stuff that Damon was looking at. And here is Microsoft on the market profile chart. It's not quite as seductive because the day is much shorter than we'll see for obviously the S&Ps and gold and crude, but you know, it just shows this big major, wow, I don't know what that little, I've got a little elf here making all kinds of little dings. So here's something interesting that I look at when I look at these market profile charts, and I was always taught that the edge is when you have a close outside of value area, that it has a good edge for follow through the next day. Not anything long-term forecasting, but Microsoft is a pretty swank example here where you can see this yellow denotes the value area for that for this particular day of trading, and that's just a percentage function of where the activity takes place. And you can see here's where we closed that day in that little yellow dot there. So they obviously goosed this market up, and then you had the upside follow through. And conversely here, when you had that significant close to the downside out of value area, you led to more down. And you know, the stocks are like pretty gappy these days, but I thought it cool that we did close outside of value, even though we're still in this range on Friday. So that will be something fun to see how that plays out on Monday. So then the other stock, let's see, Apple. Oh my goodness gracious. Same type of pattern. It looks super bullish, right? And here's something that I've found, that when it looks really bullish and you start seeing this pattern on just about everything, it doesn't have that much left in it. And it's sometimes the best moves come from the least readable spots, you know, the funkier breakouts. This is a very clean buy. It's a very clean test of the moving average. And yes, we can go up and poke above this high here. I'm just not sure how much further up there we'll get. So same thing with Apple. I'm going to be watching to see if this does do a look above and ultimately form some type of bull trap, which coincidentally would be kind of cool if that happened going into the end of the month and you have the end of these seasonals and blah, blah, blah. That's a possibility. One other trade here, you can see how Apple ate its tail on Friday, and that is something that normally leads to follow through as well, not just looking at that with the market profile stuff. If we did look at it with the market profile, I guarantee it closed well outside of that value area. So this was sort of another way of seeing that it ate the tail. Just because there's single prints, it's telling you that that is an area of interest. And a lot of times with market profile, you hear these things: poor high, strong high, weak low, these types of terminologies bantered about. And what it means to me is this is an area of interest. It may or may not have significant implications for the next day. It's just telling you that it's meaningful if it does start to take that out. So that's the Apple. Now I had a request to look at a particular stock chart, which I think you'll agree sort of falls into this same camp. And that is this Autodesk. And that exactly looks the same, except I would say the relative strength is just a little bit better, just because it is closer to this swing high here, and it's got a gap area. So I would be most curious with this particular stock of how does it trade, if it can trade at this high, because we never know in advance if it's going to lead to a whole new leg up, in which case you could say, well, there was this previous trading range up here, and you've got the middle of that range. So that's always logical. If you can hold above this high and claw your way back into this range, then you might be able to trade to the middle of the range, which would be 87, 187. On the other hand, there's always that risk that you look above and fail and come back down. But I would say that this one is in a better position than those other ones that we just looked at, simply because it's closer to taking out that high. Now let's just look at a totally different ball of wax here. With basically a utility company, and this is much poorer relative strength. This tends to be fairly correlated with the bond market, utilities, and so forth. And I wouldn't know what to really say about this. This chart to me is very uninteresting. I would say it's pretty dead. And what I see right away is you can see the converging trend lines on this 2-period rate of change. So that's a way of saying that the market swings are lessening in both directions. The upside is lesser than the previous upside. This downside is lesser than the previous downside here. You see that? So when you form these coils, you might think that it could lead to a big breakout, right? That would be our first line of thinking, and that is always a possibility. But I'll tell you something interesting with our testing and modeling that we did many years ago, and that was that the markets that had a low ADX reading or lower ADX readings, and I don't know what the ADX is on this. I imagine it's still on the high side, but probably much lower than a lot of other markets. Oh, there you go. You see how low that ADX is there. So you don't need these oscillators and these indicators to tell you. Your eye can automatically see that we are in this lots of price bar consolidation and equilibrium level, right? Right? So you got that. And so what our testing showed is that when you had the ADX this low, it led to the most amount of false breakouts. Okay, so that's what I would be careful of, would be that this market starts to have a little bit more noise and more false breakouts. So that's sort of a counterintuitive thing. And my thinking initially when we were trying to model this was, well, let's just look for all the markets with the low ADX reading, be it on an hourly chart or 120-minute chart or daily chart. And we tried this on everything. And lo and behold, it said that, if the market's dead, it's most likely to remain remain dead and you get more noise and more spikes. So I would just be really careful. I would want to see a stock that was in play and make a better bet on that. So the stuff that I've had that looks super cool has been a lot of the semiconductors, obviously tech stocks, and this one's been super cool. Uh, I'm sure everybody knows the stuff that's been hot to trot, but I thought this was like particularly cool because it's just within striking distance of that all-time high. And sometimes, like I said, these things are a little bit of a trip or a trap because everybody gets super bullish right when it gets to that high. So they got to chop around back and forth for a little bit, just kind of like our gold chart is doing. But I mean, this would be one I would still be drooling if I could get a pullback on it. Another one, Newmont. I mean, this has been on fire. So you look like you might be forming a little bit of a sell divergence or a loss of momentum on this leg up. But I would say, going forward for the next 2 to 3 months, any pullback to that moving average, I'm just all over that. I love that one. And here was another one, semiconductors. I just picked this one because it wasn't nearly as as far ahead of itself as AMD. But the whole group is obviously got some bid to it. And then on the downside, what would I be looking for on my shorting list? Is a lot of these financials. This would be an ideal stock if this pushed up, and failed. So if we had a little push up in this oscillator, which kind of is a little bit more oversold here, I just think that this is going to run into trouble on a rally. So right now, I'd be looking to see, can you give me some last juice here over this next week? But most of these financials just don't look really compelling. Look at this horrible chart of JP Morgan, so I take the weakest ones like this, and then right now this oscillator is saying give it a chance to pull itself back up by the bootstraps here. But these are the types of things that I would be looking for to rally to short. Don't make the mistake of picking the strongest stuff out there and thinking it's gone too far too fast and it has to come back in. So that's there may not be much play in some of these, but other ones, obviously Goldman Sachs can be a really good trading stock. I just don't know if it's going to be able to get back up above 187, 190 or not. So for now, there's still a little bit more juice on the board. To the upside, I don't know how or why or where it's going to end. I don't feel that there's a good top in place yet, but I do think that most of the bullets have been used up. And so with that, I like to go down and just look at the 120 and the 240-minute charts. And this is my favorite grid. When I come in the morning, this is what I like to look at, is this 120, the 240, and the daily chart. And that kind of gives me my best feel for what's happened overnight. Now, obviously, this is Apple, so I wouldn't be looking at that. But let's say, for example, this euro currency, which should have a pinball sale. Now, we did have a pretty nice price rejection spike there. It was the first day up. Okay, so it can have one more day up. But I like to see where we have these channels, if you will. And this is kind of a big old chart formation here. It's not really a channel, but the point being, when you enter more of this rotational or equilibrium type of environment, don't go thinking where is the next big swing on the daily charts. Okay, that's not the way to go about it. Instead, think about, okay, can I trade off the 120 and the 240 minute? And more likely than not, that's going to, you'll find some good plays. So even if I came in the morning, and with this gold, I'd still be saying, well, can it push up a little bit more? Remember the silver, we like the silver a lot more, just because here you've got this, look at this pretty little buy divergence down here and this ABC, and there might be a little bit more to play with. So that's it. That's all I really want to say and wrap up. I'm going to look and see if there's any questions here. Just to sum up, seasonals, they're getting the tail end of them here. The shit doesn't really hit the fan until like the second week in May. Then you can get some more rolling down. There's still a little bit more upside room on these sentiment things. They haven't like hit frothy levels, or there's not a lot of believers out there so far. So that could have a little bit of support still. God knows the monetary conditions are just fabulous. So let's see, sometimes when you have these earnings weeks, you have a positive bias during the earnings reporting period. And then afterwards, it's sort of the hangover time. So that's a real loose model there that you could get the hangover from that. The gold, remember, range trading, don't get chopped up in there. I know it's like easy to be super macro bullish, everybody is, and with good reason, because they're basically going to continue to devalue the dollar and all the currencies. I think that's the only way they can manage this stuff, but just be careful. Everybody's in the same boat there, and this crude is probably not going anywhere fast for a long time because the commercials seem to indicate that. Now I'm just going to look and see here. Somebody was asking if I use Bollinger Bands. I really don't. These are Keltner channels, just so you know. Everything that you see on my chart is an average true range function, and I just use the default setting, which is 2.5 ATRs centered around the 20 period EMA. So basically all the modeling I do is based off range functions, price, average true range, that kind of stuff. And moving averages, this is a 5-period simple moving average. It's just a little gimmicky trick when you start to get this persistency of trend on one side or another, but there's nothing significant about that. In fact, there's nothing statistically significant about any moving average out there. Keep that in mind. You can model this stuff till the cows come home, and you're not going to create a viable system using a moving average. I mean, there'll be periods where it's hot, 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 and then periods where it'll just get whipsawed to death as you start to enter range trading. So all of these things are just tools for your eye to help add some structure to it. There's really, really hard to come up with an indicator that's going to, be quantifiable, okay? And that's because they're derivatives of the price, and the price will always lead. So most people won't be able to come up with a system that's durable and robust based off of indicators, but they're fabulous tools. Looking for the divergences at the end of swings is one of my favorite plays. So Damon trades mostly with intraday volume and market profile. Yeah, absolutely. And I trade intraday swing trading positions, 1 hour, 2 hour, 4 hour. Well, let me tell you, the more volatility that the market has, the greater the length of line, okay? And the S&Ps have the best length of line ever. So I love the tick charts for trading these E-minis. I use a 5,000 tick and a 12,000 tick and a 20,000 tick. So all of these can sort of equate with like 4-minute, 5-minute, 10-minute, 15-minute, just depending on the volume and the volatility. And absolutely, with these S&Ps, I mean, you could go down and trade them on a 2-minute chart because there's that type of volatility and opportunity. But with most of these other markets, say for example, the gold and the crude and the euro currency and the grains. I mean, my main thesis is try to get the main idea right. Try to get the trend for the day right, and then we can evaluate the next data point. Occasionally, we get a day where there's good range expansion, and that will tend to lead to follow through for the next day. Those lend themselves to overnight trades. holding that position overnight if you've taken it, if you're ending with a profit. For example, wheat had a really great range expansion day on Friday. If I were to go to this wheat market here, you can see that it gave the range expansion out of this 3-bar triangle. And here's your range expansion, and then that's a day that has very high odds of taking out that low. So sometimes, not often enough, believe me, but sometimes we get those types of plays in which there's not really an hourly component to that. It's not like you look at 60-minute charts or 120-minute charts or 30-minute charts. It's more that, we have the parameters for the volatility breakout system, which could be any parameters. Trust me, that's like, there's not a right or wrong set of parameters, but just something to tell you a la Toby Crabell style or Larry Williams style or Bob Buran style, or there's like a million different ways out there that you can get that. So I'm always trying to see if I can capture one of those a week, and kind of depends on the week and how it's going. I mean, sometimes there's just good opportunity in the S&Ps. So little bit multifaceted. I don't use the market profile like Damon does, although I truly believe in it. It's just that there's only so much that I can look at, and for me, the fewer things that I look at, the better. So get the main idea right, and then heck, there's nothing to say that you can't go down to little 5-minute charts. I think I've got a grid here of nifty little 5-minute charts somewhere. And I'll tell you another trick I do. You guys are going to laugh, but I mix it up. Sometimes I look at a white background with candlesticks. I'm not a big candlestick person, okay, but sometimes I do that just to wake myself up, and I'm basically looking at, for a little flag. These are 30-minute charts, but I can make them all 5-minute charts. Isn't that cool, the way that you can do, like any program, CQG or TradeStation or something, one mouse click, you can just boom, see everything at once. If you're wondering what these little funny dots are, okay, you're going to laugh, but these dots are just when the slow line has a positive slope. See, and these little blue dots are when the slow line has a negative slope, and you get the 2-period rate of change doing a negative slope. And I don't normally watch those. I just put them up there the other day to see how they would look, because it's something I use on the daily charts. So sometimes I go to a black background. I don't normally look at this screen. This is something I use first thing when we come in the morning. This is just the 8 o'clock reading, so I can see where the big gaps are. So for example, silver, you can see this is where we closed the one day and then where we gapped up. And I do that to see if we get gap on that 8 a.m. reading and then trend, or gap and then trade back into the gap. So, I just do that for my brain to mix it up a little bit instead of always looking at a black background or a white background. But yeah, I can't trade off 5-minute charts. I can say, gee, I like the wheat to the downside, because this is poised to flip down, and then maybe look at a little 5-minute chart, but I can't trade that way because I will get chopped up in the noise. Now look what's happening to our gorgeous little Aussie dollar. Remember, this was our #1 currency that has this long seasonal window for the next week. And this is what I try to find are these ABCs with this red, green, red on a 240-minute. So if I can find something like that on a higher time frame, okay, that to me is like, get the main idea right. Then if you want to go down to a 5-minute chart where you can see a little pullback or bull flag, or even a 15-minute, maybe a breakout from a triangle, heck, when these things are moving, maybe you got to go down to a 2-minute, you see? But it's really, really challenging to make a living just doing 5-minute charts. Unless, of course, it's the S&Ps, because they are the only market I know of that lends themselves consistently to having 2 or 3 intraday trades. Yes, crude has been crazy, and there are some intraday trades on crude. It has gone through periods too where that is not the case. So you'll find that just about any trade that I would make, okay, based on an hourly chart or a 120 or 240, can be used for day trading. You just exit at the end of the day. That's all there is. You just choose not to carry it home overnight. There is absolutely nothing wrong with that. So don't get too caught up on these time frames, because the market has a little mind of its own. That's the beauty about tools like Market Profile, is that they are time frame independent. Okay, so they're not going to be, you know, so linear in their parameters. They want to give general zones and general ideas and levels. And so I just want to make that clear, because I think that people mistakenly perceive of day trading a lot of times, not always, but as being like using 5-minute charts. And I don't think that's really the case. I think there's some really excellent traders that use Market Profile, and they don't take positions home overnight, but you can get 1 or 2 trades a day. So I hope that helps. How do you set exits for both wins and losses? And that's a really good question, because you're not going to make any money if you don't have good risk control. I can tell you my philosophy, and that is with the losing trades. Well, when you make a trade, okay, very first thing, when you put a trade on, you need to have an idea as to the level that you would not want to see that trade, that market go. Okay, so that's called basic support or resistance. So let me just give you an idea. Let's say this crude that I'm short for whatever reason, you can see it looks pretty damn good short on this 240-minute, right? But just pretend that this is a 5-minute chart and just say, okay, I just shorted this. It's a 5-minute little bear flag. I'm going to see if we can get a push down into this little pocket area. You built a little bit of a base here, so maybe we just want to see if we can test down into this little area right here. All right, so just pretend, humor me, and say this is a 5-minute chart. Well, where would you not want to see this market go? That would be obvious. You wouldn't want to see it go right here. So for your losses, where is it that the market shouldn't go for your particular trade? Obviously, if I'm looking at the 5-minute chart now, it's way oversold. If I shorted this here, I certainly wouldn't want to see it come back up into this prior range. If I bought it, which would be a little bit crazy, if I bought it, I would want to see it immediately do a test and a reject and come back up above this swing low. So if I were looking to buy this, which I'm not, but I would need to see that type of action. So I would need to see this stop going down, in which case I would just say, you know, it's a dicey marginal trade location. I really don't want to see it, you know, go down here. You know, it's done a little bonking here. Let's see if it can come back up above this swing low. So you have to assess, you know, when you make a trade, if I'm right with what I'm thinking on that trade, where is it that that market should not go? And then that's going to tell you where to, you know, manage your risk. Now, on the flip side of the coin, targets, okay? I don't like to put initial targets on a trade for a very distinct reason. I always have a level for something that I am looking for, you know, a test of a high. Can we get up to this area? Yes, we have to have these things in mind. When I make the trade, I don't put in immediately a target, because I've learned that the markets, the beauty of the markets is that they offer this prospect of fat tails. And that's where our big wins come from. And maybe 1 out of every 20 trades will be a big win, like that wheat trade to the downside. Okay, but I don't want to cut off my nose to spite my face. Most trades are not going to be there, giving you that big win, but I'm going to at least give them the chance to prove themselves and see. Okay, so when there's an increase in volume and an increase in activity and an increase in the volatility, I want to see what that market can give me. And so I'll be much more mindful to kind of trail a stop and protect, that open trade and that open profits. But I don't want to try and say where that market is going to go. This is a good little market right now, and it's got some upside potential. I don't know if this can take out this high yet or not. The structure suggests that it can, and there's more upside. I mean, it could give a whole new leg up here. I mean, gosh knows that this is pretty oversold, but I'll just manage that the best I can. So I don't put in an immediate target unless I know that it's not a high volume day. If it's a lighter range day, of course, I'll put in a small target, and just, you have to kind of work with the market a little bit and work with the volatility that it gives you and the structural points that it gives you. And so there's several ways that you can then exit. And when we were doing our modeling and testing systems and strategies, this is what we did. We used a combination of exits. So one could be a time exit that if it didn't reach a certain level by 8 bars or whatever the case might be, if it didn't at least give you one ATR within 8 bars, that could be a reason for an exit. Number two, if there was a loss of momentum, for example, you started to see a sell divergence at the top of the swing, that could be the case of an exit, and likewise trailing a stop. So don't box yourself into just one strategy to exit. And of course, it's all going to depend on what the structure is. If it was a breakout trade or if it, these kinds of things. So I hope that answers your question. And I think that's, oh, I see. There's a whole nother set of questions here too. What is the, I'm just going to go through these a little bit here. I'm not going to analyze the Indian index because I don't watch it and I don't even have data for it. So I can't really do that for you. But what you want to do when you look at a market, you want to look at the higher time frame. You want to look at where the swing highs and swing lows are. Is there an increase in momentum or not? And that's a good departure point. I have done most of my testing and modeling on TradeStation, and it's worked just fine for our purposes. TradeStation's database is okay. That's a big consideration when you're doing testing, is the data that you're running it on. And for my purposes, I'm just looking for maybe 2 variables and combinations of things. So TradeStation's been perfectly fine. We're not doing high frequency trading. I don't know for sure if we're going to be doing another workshop or not because we started this monthly service, but if we do another one, it's not going to be until September or October. So if I get a better idea, I will certainly put something up there because I've had a lot of people ask. I just, it's pretty time intensive, and I want to make sure I can give my full attention to these markets. The volume profile, do I use the volume profile? It's actually a great tool to see the volume distribution on the side. You can train your eye to see the same thing. So for example, I can put up a volume profile and it's going to show a very thick high volume node here. So I think that's a great tool. It's very similar to the market profile, and I think almost all software packages except TradeStation offer it. This is CQG that I'm looking tonight. And so anyway, do I have an example of a U-turn long or short? Sure, well look at this chart right here. All a U-turn is a failure test, and it usually happens at the end of a long swing. So I mean, this just happened to be up here, this Australian dollar with this magnificent downtrend on the 240 minute, and here was its flag, right? Nice little bear flag, almost like what we have in this crude oil on the 240. So this should do a full retest down, but when it puts in a higher low like that, and it has to be at the end of the swing because you don't want to get chopped in, that's your U-turn point. And you have to put it in the context with the big overall structure that it's very oversold. So here's the deal with these. An aggressive trader likes to go long on the higher low, and a conservative trader might put in a buy stop around this point. When I was trading and we were like on the floor, and then when we were off the floor, we would usually try and front run these points. We would usually try to buy ahead of time, and you can see it's not perfect. You could buy ahead of time, and then you also are left with doubts because this could form a triangle. And then once you go through that point, that's your U-turn point. And it's just how tight to the vest you want to play this. So you can do this with any data, but just think of a U-turn as being a failure test. You had a high probability flag formation that failed to give its full retest, and then that's what sets up that U-turn type of thing. Just a gimmicky little structural point. Yes, look at that oil, huh? Look at that oil. What are we doing with this oil? Remember, we talked about, okay, if you were looking at that 5-minute chart, you would want to see it turn back up there, right? And you got right above that swing low. This would have been our stop, okay? And there you go. So that goes to show that you can make a trade in either direction at any point in time. If you want to be a buyer, you can be a buyer. And if you want to be a seller, you can be a seller. You can make a trade in either direction for any reason you want, as long as you have your risk point or your stop, okay? So lots of ways to frame out technicals, momentums, and flags, or in a bracketing market, which you can start to call a consolidating market, you will be much more prone to these little test reject types of spikiness, if you will. I'm not sure how much you'll get out of this. Now it's up to you to manage your trade. Do I see any value in candles over the bars? I only really use the candlesticks for the daily charts. That's just me. Most of my intraday stuff looks like this, and I rely much more on just the oscillators to provide a smoother feel. And so I'm not a bar by bar type of person at looking like little 5-minute candlestick charts. It just draws me too close to the noise level. But everybody, I have a friend that does nothing but look at the 5 and 15-minute candles, and he makes a great living scalping off that NASDAQ future. So there's no right or wrong. It's what you like. Does this? I don't have any paperbacks or audiobooks or Kindles of the Trading Sardines for now. International shipping, I think 45% of the sales of the book have been to international locations from the fulfillment center. But if you are in a place where that's not possible, I'll put it on my list, one of these days to get around to, but it's just I need a good chunk of another 30 hours to pull something like that off, and it's just not going to happen right now. Love lots of trend days. What do you look for confirmation for a trend day? Well, ideally, you want the trend day to be happening right off of the opening price, or, right out of that morning initial balance. That's when you want to see the trend day get underway. You want to see an increase in volume. That's ideal. And, you know, the early on price bar continuing on up, higher highs and higher lows. But uh, every market has its own little distinct personality. So the ATR settings are 2.5, and the moving average is a 20 period EMA. And I usually do my homework just working off of those daily candles for starters. And naturally, everything changes overnight, right? I could come in this morning saying, gee, we've got a little bit more upside bias, and we could come in and it might gap up 20 or 30 handles tomorrow. So, you just have to work with the market in these conditions these days. No, please do not worry about being good at 5-minute charts. I don't know of anybody that has made a consistent regular living off of 5-minute charts. I couldn't do it. Does that make you feel any better? I mean, I know what to look for in selective spots, and I could sit there and grind out like some small wins and get some consistency, but you got to be in the markets with a bigger purpose. They are so bountiful, and it's just, the problem is it takes a lot of time to see the bull markets, the bear markets, the contractions in volatility, and the expansions in volatility, and all the different regime changes. So that's part of what you're learning every day, that you sit in front of the screens. And it's okay to look at 5-minute charts, just because it's a great way of managing your risk. I mean, you're not going to lose so much money, but you're really not going to make so much money either. So it's okay, because it's going to get you comfortable with short-term execution. But I could not make a living off of just looking at a 5-minute chart, and I'm really being honest. I think it's very important that you understand how to capture a good chunk of a trend day when you have one, and that's really where the money's made. So oh my goodness, greetings from Poland. You are way past your bedtime. Holy cow. Yes, the red, green, red rule, exactly. It's Wells Wilder's volatility. That's all it is. It's public domain. It's out there. It's printed out. It's not a trading system. Absolutely. It's nothing mechanical about it. It's just a cute little crutch for highlighting the swings. It's just a pattern recognition tool. It's going to highlight the little bull flags and bear flags. And so that's all it is. I've programmed that in on CQG and TradeStation. And do I always take partial profits on multiple contracts? No, I don't. Most of the time, I don't. Most of the time, I'm all in and all out. But that's okay. It's, if it helps psychologically to take partial profits, anything that helps you psychologically, for sure, for sure. I figure I'm putting in enough concentration into managing the trade that I have on. I might as well give it my all for managing that piece. And I'll give you a good rule of thumb, okay, for if you are used to scaling out or taking partial profits. And that is, as long as you're doing that, taking profits on a piece and then trailing a stop or seeing if you can get better on the second, keep track of that you are indeed getting better on your second exit, the majority of the time. Is it really paying for you to do that? Or would you have done better just to exit everything at once? Because I'll tell you what happens with me. I might see a great little climax and take partial, but then I have this position that's still half on. And then I'm either kicking myself that I didn't exit the whole thing at once, or else I get trapped into the sucker's play of like rebuying back the part that I sold, and I sold really well. and then it kind of messes everything up. So that's just what happens with me. I do best when I'm clean in and clean out. And then if I want to get back in, I get back in and it's a new trade. So that's how I tend to manage that. Yeah, yep. Damon said it all. It all depends on the volatility and the formation. It's hard to have too many hard and fast rules. It's good to just think of things as guidelines. So you guys are a you guys are a great group. Okay, the point, I'll say one last question here. The point with the burning dog, okay, is that 4 points, trading into that gap for 4 points was relevant when the market was having 20 and 30 handle ranges. It's not significant to look for 4 points back into the gap, with these ginormous ranges we've had, because 4 points can happen in 30 seconds. So think about what the principle of the burning dog really is. It's really saying, if you have a gap, first of all, keep in mind, is it a gap outside of the previous day's range, or is it a gap still in the previous day's range? Because those will be more likely to be filled. If you're gapping outside of the previous day's range, or just say a big gap, are you going to trade into that gap or not? And the best moves will happen where you don't trade into that gap at all. It's not, whether it does by 2 points, 4 points, or 30 points. It's just, is it a gap and go type of thing? So the burning dog wasn't created as a mechanical system. It was just modeling gaps. And therefore, we didn't ask a question of a stop on it. We simply looked at what was the percentage of time that it filled the gap by X amount, and what happened when it didn't fill that gap by X amount. And was there a time of day function relevant to this gap? And there was. And if the market's going to trade into a gap area, 90% of the time it's going to do it in the first 2 or 3 hours of trading. If it doesn't, then you have greater odds of moving off in the direction of that gap. So I think that's about it for tonight, gang. I'm going to finish up my homework for tomorrow morning. What I do with our trade room and what Damon does is I post my charts, at night, the setups that I'm looking for, and then we upload our trade sheet, and I upload my little worksheet, whether it's a buy day or sell day or sell short day. And I have been a little bit tardy and late in getting these uploaded on a timely basis. I try to do them before 8 o'clock at night, and it's been a little bit later 1 or 2 nights. But then you need to do your own homework. And then what we do is, when we come in the morning, we look at how the market's traded overnight relative to our game plan, and see if we still have an edge with that game plan, or if we need to make some modifications. And as Taylor says, having a game plan is better than not having any game plan at all, right? Because if I have something that says, gee, I'm looking for a bullish bias in these S&Ps for the next 2-3 days, but then they just really fizzle and start to see a little bits of downside impulse, and maybe we take out 2780 or something to the downside. Oh no, my game plan was wrong, trust me. So you guys all have a great rest of the week. Thanks for joining us online. We'll try and do this at least once a month. It's a great exercise for me. And again, happy trading. And Damon, you get the parting shot here. I'm sorry, I was blabbing.
All right. No, you said it all. I'm sure you covered it. Thanks a lot for coming on. You could, if you're interested, by the way, in the trading room, let me just put this up for a second, because we forget to even, we're not very much at marketing, but people do want to know. So you will put this up. If you're interested, you could just go to lindaanddamontrade.com, read about it, and if you want to sign up, come and join us. You can also look at on Twitter. We post some, charts. Most of you probably see our charts, but if you want to see some charts that we post and some of the comments that we do. Linda, you can, uh, type in questions into Linda, what's it, lindarashke.net, the contact
Yeah, on my
form,
website, there's
right
just
on
a
our
generic
website.
form. Just a
Right,
generic form.
right. And if you have any questions, you can just send me an email at damon@fptrading.net. So with that being said, thanks a lot. I hope you got something out of it. I'm sure, Linda had a lot of good stuff. I hope you understood what I was showing you and I could give you a little insight there. And if you have any questions, give me a ring. And that's it. Have a good week trading. And we'll
Night,
talk
guys.
to some of you soon.